Here's something nobody tells you about investing. You don't need to be rich, you don't need to be smart, and you definitely don't need to know how to pick stocks. In fact, trying to pick the next hot stock is one of the fastest ways to lose money. The whole thing has been wrapped in so much jargon, ETFs, expense ratios, asset allocation, that most people just freeze. So they wait. They tell themselves they'll start once they understand it all, or once they have more money, or once the market finally calms down. And while they wait, the single most powerful force in finance, time, is quietly slipping away. Because the cost of waiting is not zero. Every year you sit on the sidelines is a year your money could have been compounding for you. And that's a year you can never buy back. So let's fix that today. By the end of this video, you'll know exactly what to do in order to go from zero to actually invested, using the same boring, proven approach that quietly beats most of the professionals. No hype, no stock tips, just the mechanics. Before you invest a single dollar, you have to get the order right. Because investing too early can actually cost you money. Think of it as an on-ramp with 3 stops before you merge onto the highway. Stop 1. Knock out any high-interest debt, like credit card balances. If your card charges 20-something%, paying it off is a guaranteed risk-free return that no investment on earth can promise you. Stop 2. Build a small starter cushion. Even $1,000 set aside means a flat tire or a surprise bill won't force you to sell your investments at the worst possible moment. Stop 3. If your job offers a 401k match, grab it. That is free money, an instant return before the market does anything at all. Turning it down is like turning down a raise. Only after those 3, debt handled, a small buffer in place, and the match captured, does putting money into a regular investment account make sense. Skip the order and you could be earning 8% in the market while bleeding 22% on a credit card. That's not investing. That's running up the down escalator. Okay, so what does investing actually mean? Forget the image of someone glued to 6 screens, buying and selling all day. That's gambling with extra steps. Real investing is simpler, and honestly, far more boring. You're buying small slices of ownership in real companies, and then letting those companies do the hard work of growing your money over time. Here's the insight that changes everything. You do not have to guess which single company wins. Instead of betting everything on one stock, a dartboard throw where you're usually wrong, you can buy a tiny piece of essentially every major company at once. That's what an index fund is. When one company stumbles, others are climbing. You're not betting on one horse, you own the whole field. So the goal was never to become a genius stock picker. The goal is to own a slice of the entire economy and then stay in your seat while it grows. Here's where people get tangled up. So slow down for this one. The account is not the investment. The account is just the container, the bucket your investments sit inside. And which bucket you pick changes how much tax you pay. There are 3 you should know. First, a regular taxable brokerage account. No limits, no special tax breaks, total flexibility. You can pull your money out anytime. Second, a Roth IRA. You put in money you've already paid tax on. It grows for decades, and qualified withdrawals in retirement come out completely tax-free. And third, your workplace 401k. It often comes with that employer match, and it lets you invest a much larger amount each year. The retirement buckets, the Roth and the 401k, come with annual limits and rules about taking money out early. But in exchange, they hand you a serious tax advantage that the plain brokerage account simply doesn't have. So the move is this: open the right container first. Most beginners do great starting with a Roth IRA or their 401k. If there's a match sitting on the table, your account is open. Now, what do you actually buy? This is where that index fund earns its keep. A single broad index fund, one that tracks something like the S&P 500 or the total U.S. stock market, instantly spreads your money across hundreds, even thousands of companies in one purchase. One click, and you're fully diversified. And here's the part the industry would rather not advertise. Over the long run, this boring approach beats the experts. Across 15 and 20-year stretches, the large majority of professional, actively managed funds, run by people whose entire job is to beat the market, fail to even keep up with the simple index they're chasing. Over the long haul, it's roughly 9 out of 10 of them falling short. Read that again. The pros with their research teams and their expensive terminals mostly lose to a fund that just owns everything and sits perfectly still. So you don't need to outsmart the market. You just need to own it, cheaply. You've picked what to buy. Now make it impossible to mess up. Automate it. Set up an automatic transfer, say every payday, that buys your index fund without you lifting a finger. This does 2 quietly powerful things. First, it removes you from the equation. Your fear, your excitement, your urge to wait for the perfect moment. And that's a good thing, because nobody can reliably time the market. Not you, not me, not the professionals. So stop trying. Second, by buying on a fixed schedule, you automatically buy more shares when prices are low and fewer when they're high. It's called dollar cost averaging, and it turns the market's scary dips into your quiet advantage. Then comes the hardest part of all. And it's not hard because it's complicated. It's hard because it's boring. You wait, you let compounding do its thing. The investor who simply keeps buying and never panic sells almost always ends up ahead of the one who jumps in and out trying to look clever. Time in the market beats timing the market. Every single time. One last step, and dollar for dollar, it might be the most important one. Watch your fees, because they are silent and they are brutal. Every fund charges an annual fee called an expense ratio. It sounds laughably tiny, 1% versus maybe 0.03% for a good index fund. A rounding error, right? Not over a lifetime. That little gap, compounding across 30 years, can quietly swallow a quarter or more of your final balance. We're talking tens, even hundreds of thousands of dollars that should have been yours, handed to a fund company for doing nothing special at all. Same investment, same market. One tiny number deciding how much you actually get to keep. So the rule is dead simple. Choose low-cost index funds. Check the expense ratio before you ever buy, and keep more of what's yours. In investing, the less you pay, the more you make. So there it is in your whole path, start to finish. Get your money in order. Kill the high-interest debt. Keep a small cushion. Grab the match. Understand what you're really doing. You're buying the whole market, not gambling on one stock. Open the right container. A Roth IRA or your 401k is a great place to begin. Buy one low-cost, broad index fund. Automate it, then leave it alone and let time do the heavy lifting. And guard your returns from fees. That's the entire system. No crystal ball, no hot tips, no perfect timing required. Just a simple, boring machine that has quietly built more wealth than all the frantic stock pickers combined. The hardest step was always going to be the first one. And by understanding this, you've already taken it. If this made investing feel less scary and a lot more like something you can actually do, hit subscribe, because that's exactly what this channel is for. The money stuff nobody ever taught you, explained plainly. Next up, Roth versus traditional. Which retirement account actually leaves you with more money at the end? It's closer than you think. I'll see you there.